The market update desk, Scott Riley and Mortgage One. It's November 16th, and we get the wholesale read on inflation on the heels of the fantastic consumer inflation that we got yesterday, those reports. Let's kind of break down the wholesale side of it and see where that's leading us to in today in the market. Now, yesterday, we had a significantly better consumer inflation or retail inflation report than what we expected. That led up to a gigantic run up in the stock market, the Nasdaq, the Dow, the S&P, huge returns. And also in those markets, we're also still on earnings season. So the big magnificent seven tech companies are rolling today. In fact, Target was up about 15% on a better than expected sales numbers and profit. So let's kind of go into what's happening today. So the producer price index overall showed wholesale inflation drop by 0.5%, which was significantly lower than the expected 0.1%. In fact, it's the largest decline since April of 2020. Year over year, producer inflation or wholesale inflation fell from 2.2% all the way down to 1.3%. We're now on a one handle on wholesale inflation. Huge, huge improvement. Again, this was better than the estimates of 1.9%. The Bureau of Labor and Statistics, BLS, indicated that 80% of the October decline in producer price index was accountable to the drop in gasoline. So we've talked about West Texas Intermediate Crude, WTI, dropping the last 3 to 4 weeks by almost 15, 20%. That now has filtered through to the inflation data, and that's great news. Consequently, this should also help us on the PCE report, personal consumption expenditures, when we get that in 2 weeks. So we should get some good news on that too. So on the PPI, the core, which strips out the volatile food and energy, was flat, which was also much lower than the market expected at an increase of 0.3%. Year over year, the core fell from 2.7 to 2.4%, while it was expected to be at 2.7. So also the core, we're inches away from having a one handle on core, which is great news. What's that done now to what the Fed is thinking for inflation readings and what their monetary policy is going to be? In fact, the market is now expecting the Fed to basically turn the car around and cut rates much sooner than what they had previously forecasted about 2 months ago. Let's kind of break down what the futures market is showing. January odds of a hike went from a 30% probability to a 2% actual rate cut. Big turnaround there. The March odds of a hike went from 14% to a 33% chance of a cut. May odds went from a 50-50 cut to an 85% possibility of a May cut. Much more improved. And now June is actually factoring a 100% opportunity for a rate cut. So before the Fed was talking about maybe cutting the rate 3 times next year in the second half of the year, we're now looking at the opportunity and possibility of 4 rate cuts next year, but starting well before what they forecasted just 2 months ago. The other big number that came out today was retail sales. That dropped by 0.1%. It actually is a little bit of a hotter number than expected. The market was baking in a 0.2 of a decrease. So a little bit stronger than what the market had read. And in fact, the previous month, September numbers were revised from a 0.7 gain to a 0.9 gain. So we had a positive revision to retail sales just from last month. What is also apparent when you dig into the numbers is that the bias of this continuing spending by the consumer is shifting from discretionary to non-discretionary, and they're lowering the price point of what they are looking at. State tax numbers have been declining now for multiple weeks in a row, even though retail sales are going up. Even if this fewer tax revenue doesn't sync up with retail sales, It likely will through revisions because state tax revenue doesn't get revised, it's real time numbers. So we probably could get a revision in the next couple of months to the retail sales that we're getting. Mortgage applications increased a little bit last week, both on applications and refinances. What does this mean for buyers? We've seen almost a 1% decrease in rates over the last week. Big uptick in potential buyers. We're seeing the phones ring a lot more than what we did for the 4 previous weeks. What we've been talking about is once rates start to dip, your competition will go up incrementally. So instead of, at the higher interest rates, you have significantly fewer competition buyers than what you do with lower rates. What that means is potentially a higher sales price and a dogfight trying to get an offer accepted. Tomorrow we get jobless claims, both initial and continuing claims. Our suspicion is the continuing claims are probably going to come in higher than what the market is expecting, which could help the market. Today we are seeing a little bit of a clawback in mortgage-backed securities and the 10-year treasuries. Traders are taking some profit off the table, which is not surprising based on the big gains that we've had in both of those over the last 3 days. Let's see where we go the rest of the day, go into tomorrow, seeing what the jobless numbers are going to be. And then Friday brings new housing data. So we'll see what happens with that. Give us a call. Let our knowledge get put to work for you. 616-293-2189.